Everyone keeps repeating that sanctions are crushing Russia. But what if the real story is the opposite? What if the biggest sanctions regime in modern history didn't isolate Moscow at all, but accelerated the birth of an entirely new financial architecture led by Russia and China, one that has already rerouted $260 billion in trade flows outside the Western system? Stay with me because what comes next changes everything. Here's what mainstream analysis gets wrong. It treats sanctions like a wall. In reality, sanctions behave more like water pressure. Block one channel and the flow doesn't stop, it forces new channels into existence. That's the paradox. The weapon that was supposed to create strength for Washington became the very weakness, exposing the limits of dollar power. Most people think the story is simply Russia selling more oil to China. But here's what's really happening. This is a three-system bypass strategy. First, trade settlement migration. Second, infrastructure substitution. Third, reserve and liquidity redesign. If you want to understand the future of global finance, just look at the Russia-China corridor. Let's start with System 1, settlement migration. The headline number everyone quotes is $260 billion in bilateral trade, but this is the part that should surprise you. It's not the trade volume itself that matters. It's the currency composition. In 2021, less than a third of Russia-China trade was settled in rubles and yuan. By late 2024, that figure had surged above 90%. Let me show you the numbers that matter. This is $234 billion in non-dollar settlement channels, not some vague de-dollarization trend. Why does that matter so much? Because sanctions only work when choke points remain under your control. Dollar clearing, correspondent banking, SWIFT messaging, these were the old arteries. Russia and China didn't just find a workaround, they began replacing the circulatory system itself. When I was in Beijing last year, a senior economist told me off the record that the real breakthrough wasn't political alignment, it was operational confidence. Once large commodity invoices cleared reliably in yuan, behavior changed almost overnight. Firms stopped treating local currency settlement as a contingency plan and started treating it as the default. That shift is psychological before it's financial. Here's what nobody tells you: trust compounds faster than treaties. Once state banks, energy firms, and shipping insurers see repeated settlement success, the network effect takes over. And network effects are brutally hard to reverse. Now layer in the energy story. Russia redirected crude, LNG, coal, and pipeline gas eastward, while China gained discounted strategic supply. The exact trade figure that matters here is $129 billion in energy-linked flows alone. This is the Russia sanctions paradox. The more Europe reduced exposure, the more China deepened structural dependence on Russian resources at favorable pricing. And here's the uncomfortable truth. The bypass is not just about avoiding pain today, it's about rehearsing for a world where the dollar is optional tomorrow. That idea makes policymakers uncomfortable because it challenges the hidden assumption behind sanctions that no rival bloc can scale an alternative fast enough. Right after the first wave of settlement migration, I started hearing from shipping analysts and commodities desks that the written data trail was even more revealing than the public headlines. The deeper tables, source documents, and the flows too detailed for video are where the real picture emerges, and that's exactly what goes out in my free weekly briefing before most people catch on. So here's what matters. System 1 is no longer a workaround. It is becoming habit. And once habit enters sovereign trade behavior, reversals become politically and economically expensive. But this is only the first force. The second system is even more sophisticated because it answers the one question critics still ask: how do you move money safely if the West still controls the pipes? The answer lies in the infrastructure layer, and that's where this story becomes far bigger than Russia and China alone. Because once payment rails, insurance guarantees, and commodity exchanges sink outside Western oversight, you're no longer looking at sanctions evasion. You're watching parallel globalization, and countries studying the model are not who analysts think. The next layer reveals why this could reshape power in Asia and Gulf. So here's the second force at work, and this one operates completely differently: infrastructure substitution. Settlement in yuan and rubles only matters if the pipes themselves can survive pressure. Critics still say fine, they can invoice outside dollars, but the West still controls the rails. That sounds convincing until you look at what Russia and China have actually built. Most people think SWIFT is the system, but here's what's really happening. SWIFT was only ever the messaging layer. The real power sat in trust, custody, correspondent banks, and insurance guarantees. Russia responded by scaling SPFS, its domestic financial messaging network, while China expanded CIPS, the cross-border interbank payment system. Here's what matters. By linking these systems through participating banks, they created a redundancy web that reduces exposure to Western exclusion. Let me show you the numbers that matter. CIPS transaction value crossed 175 trillion yuan annually, and the number that matters for this story is the growth in Russian-linked counterparties, which rose sharply after 2022. This is the part that should terrify sanctions planners. Infrastructure doesn't need to replace SWIFT globally. It only needs to become good enough for high-value strategic corridors. I talked to logistics financiers in Shenzhen who explained something most Western analysts miss. Once the payment message, trade finance guarantee, and shipping insurance all sit inside a trusted non-Western network, the practical risk premium collapses. Suddenly, what looked like sanctions resilience becomes ordinary business workflow, and that leads directly into the case study nobody should ignore: energy equipment and dual-use industrial imports. After the first sanctions waves, Russian firms struggled to source turbines, machine tools, semiconductors, and drilling components. The assumption in Washington was simple: supply denial would force industrial slowdown. But here's what mainstream gets wrong. Supply chains reroute through financial infrastructure, not headlines. Chinese intermediaries, Central Asian hubs, and Gulf re-export platforms became the connective tissue. A shipment no longer needed a direct Moscow-Shanghai line. It could move through Almaty, Dubai, or smaller trading houses using layered invoices and local currency settlement. The visible trade route changed, but the economic function remained intact. Here's the hard truth that lands with markets. Sanctions effectiveness decays when commercial incentives exceed compliance fear. A senior commodities banker once told me that after 6 months, desks stop asking whether a route is politically sensitive and start asking whether the settlement clears on time. That mindset shift is where policy loses leverage. If you're finding this valuable, hit that like button because this connects to something even bigger, and I'll show you in a minute. Now, think about the shipping layer. Russia's so-called shadow fleet didn't emerge in isolation. It sits on top of insurers, brokers, port services, and commodity buyers willing to operate beyond G7 enforcement comfort zones. The exact figure that matters is 400+ vessels now associated with opaque Russian energy logistics chains. This is not a loophole, it is a parallel maritime services ecosystem. What they're not showing you is how infrastructure substitution changes bargaining power. Once China can buy Russian crude, settle in yuan, insure through alternative channels, and hedge through non-Western exchanges, sanctions stop being a strategic chokehold and become a transaction tax. That's why the bypass keeps compounding. The first layer was currency migration. The second is institutional confidence in the rails themselves. Once that confidence sets in, third countries begin asking an uncomfortable question. If Russia can do this under maximum pressure, why are we still overexposed to a system that can be weaponized against us? Some of the most revealing source documents on these rerouted corridors are too detailed for the video format, especially the customs anomalies and shipping insurance chains that show where the next bypasses are forming. I've already broken those routes down in the written issue that goes out before the next upload, and the people reading it first are usually ahead of the conversation by weeks. Stay with me because what comes next changes the strategic picture entirely. The third force is not about payments or pipes, it's about reserves, central bank behavior, and the silent redesign of global liquidity itself. And once you see that layer, the sanctions story stops being about Russia altogether. That is where empires shift. So now we arrive at the third force, and this is where the conversation stops being about trade mechanics and starts becoming about power itself, reserve and liquidity redesign. Most people still think sanctions are mainly about blocking current transactions. But here's what's really happening. They are rewriting how countries think about storing national wealth, pricing strategic commodities, and surviving a crisis when the dollar system turns hostile. Why does that matter so much? Because payments are tactical. Reserves are civilizational. Here's what mainstream analysis gets wrong. It assumes countries only de-dollarize when they want to challenge the United States politically. In reality, they de-risk when they witness precedent. The freezing of roughly $297 billion in Russian central bank reserves did more than punish Moscow. It sent a message to every sovereign treasury in the world. Your assets are only neutral until geopolitics says otherwise. This is the uncomfortable truth that makes policymakers nervous. The reserve freeze may have been effective as a short-term shock, but it also changed the risk model for every finance ministry from Riyadh to New Delhi. The question quietly shifted from, should we diversify, to how much can we afford not to? Let me show you the numbers that matter. Global central bank gold purchases crossed 1,082 metric tons in a single year, one of the highest levels in modern records. At the same time, yuan-denominated trade financing, bilateral swap lines, and commodity invoicing mechanisms expanded across Eurasia. This is the part that should surprise you. The real bypass is not the 260 billion Russia-China trade corridor. It is the replication potential across dozens of states that now want optionality. When I was in Beijing last year, one reserve strategist framed it perfectly. He said, nobody needs to abandon the dollar, they only need to reduce the percentage of their vulnerability. That line stayed with me because it captures the paradox. The dollar doesn't need to collapse for its coercive advantage to weaken. It only needs to become less indispensable at the margins, and those margins are where systems change begins. Here's what nobody tells you: liquidity trust is built through repetition. Once China settles Russian energy in yuan, extends swap liquidity, and offers clearing depth through CIPS-linked banks, other countries start to treat that framework as a viable second operating system. Not a replacement, at least not yet, but a hedge. The sanctions resilience paradox is this: the more aggressively reserves are weaponized, the more incentive-neutral and non-aligned states have to build buffers outside the weapon's reach. The instrument that once projected strength begins ceding its own long-term dilution. I spoke with a sovereign debt analyst recently who told me off the record that several reserve managers are no longer modeling a binary dollar versus non-dollar future. Instead, they're planning for a three-basket world: dollars for liquidity, gold for immunity, and yuan-linked channels for trade continuity. That is a very different world from the one most Western commentary still assumes. Here's what matters. Once reserve diversification aligns with trade settlement and payment infrastructure, the bypass stops being a Russia-China exception. It becomes a template. And this is where the hard truth lands. Sanctions may still inflict pain. They absolutely raise costs, slow technology transfer, and distort growth. But pain is not the same thing as strategic failure. If the target adapts by creating institutions others later copy, then the coercive act can unintentionally accelerate the rival architecture. That's the part most people are uncomfortable saying out loud. The deeper reserve flow tables, gold accumulation trends, and the sovereign portfolio shifts that don't make it into mainstream reporting are already in the written breakdown going out ahead of the next video. The people reading those numbers early are beginning to see the bigger pattern. This isn't about one war economy. It's about the future map of monetary sovereignty. Now stay with me because the final part pulls all three forces together into one framework you can actually use to understand what comes next. And once you see the three future scenarios, from managed coexistence to block fragmentation, you'll understand why the phrase sanctions work may become one of the most expensive strategic misreadings of this decade. Now, let me pull this together, because once you connect all three forces, the real story becomes impossible to ignore. What began as a sanctions regime against Russia has evolved into something much bigger, a live stress test for the future of global economic power. Most people think this is about whether sanctions hurt, but here's what's really happening. The world is splitting into layers of optionality. The framework I want you to remember is what I call the triple bypass doctrine: settlement migration, infrastructure substitution, and reserve redesign. These are not isolated reactions, they reinforce one another. Currency settlement reduces immediate exposure, alternative payment rails sustain the flow, reserve diversification protects national balance sheets from future freezes. Put together, they create resilience that compounds over time. Here's what mainstream gets wrong. They keep measuring sanctions success by immediate GDP contraction, technology shortages, or short-term fiscal pain. Those matter, yes. But if you want to understand the deeper shift, just look at system learning. The real metric is whether the target emerges with export routes, payment confidence, and reserve habits that other countries begin copying. And that is exactly what's happening. Let me show you what this actually means. The Russia-China corridor may be $260 billion, but the strategic significance is far larger because it serves as a proof of concept. If even 12 mid-sized economies replicate just 35% of this architecture in bilateral trade, you are looking at an alternative settlement universe exceeding $1.1 trillion in annual flows. This is specific leverage dilution, not abstract theory. When I spoke to trade executives in Beijing and later to shipping desks following Gulf-free export routes, one phrase kept repeating: optional rails. That's the key idea. The world is not replacing the dollar overnight. It is building enough secondary rails so that coercion loses its monopoly power. Here's what makes people uncomfortable. The sanctions tool may still be tactically effective while becoming strategically self-limiting. That's the paradox. The weapon that was supposed to preserve the centrality of the system may be accelerating the incentives to root around it. So where does this go next? I see three future scenarios. Scenario 1, managed duality. The dollar remains dominant, but major economies increasingly maintain parallel settlement channels with China, gold buffers, and regional payment systems. In this world, sanctions still bite, but they no longer guarantee strategic isolation. Scenario 2, bloc fragmentation. Eurasian, Gulf, and Global South economies create dense settlement corridors that reduce reliance on Western banks. Here, trade doesn't stop under pressure, it simply changes legal and financial geography. Scenario 3, crisis acceleration. A future geopolitical shock. Taiwan, Middle East escalation, or secondary sanctions on a major Asian bank forces neutral states to speed up reserve diversification. This is the part that should terrify markets, because system migration always looks slow until a crisis makes it nonlinear. And here's my opinion line. Sanctions still work as pain mechanisms, but they increasingly fail as monopoly mechanisms. That distinction is where most analysis collapses. Pain can be imposed. Monopoly depends on the absence of alternatives. Russia and China are proving alternatives no longer need to be perfect, only functional enough. The next written breakdown goes even deeper into which countries are most likely to become the next adopters of the triple bypass doctrine, and in many ways that conversation is already ahead of the video cycle. The people following the full written chain of sources already know which Gulf and Asian corridors are moving first. So here's the question I want to leave you with. If the biggest sanctions regime in modern history ended up teaching the world how to build financial escape routes, was the real outcome deterrence or training? If this changed how you think about global finance, subscribe, because this channel is where we challenge comfortable narratives with numbers, field insight, and the stories institutions don't want to say plainly. And I want your view in the comments. Which country do you think will be the next major player to adopt this bypass model? Iran, Saudi Arabia, India, or someone nobody is watching yet? Because that answer may tell us where the next monetary fault line begins.